Welcome back to Morning Markets on Friday the 16th of June. It's an important week for central bank decisions, and yesterday the European Central Bank increased interest rates by another 0.25%, marking the fastest interest rate hiking cycle in the history of the bank. The decision on the day was to raise interest rates by 0.25% to a level of 3.5%. This decision was expected by the market, therefore market reactions were relatively modest. If we look to the bond market, taking German bonds, shorter dated maturity, yields rose around 10 basis points, and if we look at the euro currency, it strengthened by around 0.5% on a trade-weighted basis. President of the European Central Bank, Christine Lagarde, made clear that the inflation battle is not yet over and more work may be required, which led markets to expect another 0.25% increase in interest rates in the July meeting. In July, the bank will also end the second component of the monetary policy programme, which is the reinvesting of maturing bonds. This was part of the quantitative easing package which was unleashed in 2020 to combat some of the economic consequences of the COVID-19 pandemic. To give context for the inflation challenge noted, the bank revised their expectations, suggesting that headline inflation, which is the broadest measure of inflation, should average 5.4% this year, 3% next year, and 2.2% in 2025. If we look at core inflation, which strips out the more volatile or more seasonal components, such as energy and food prices, then all of those readings are 5.1% for this year, 3% for 2024 and 2.3% for 2025. Important aspect is all of those readings are above the central bank target of 2%. The bank also recommended that as energy prices continue to fall, now for context, if we look at European natural gas prices, they peaked at 337 euros per megawatt hour in the summer of last year. They're currently now 41 euros per megawatt hour. Then government should start to roll back the support packages which were offered around energy prices to cool consumer spending, which is likely to be a politically challenging aspect to push through. They also recommended that governments do continue to push on with their infrastructure spend to enhance energy supply capabilities for the bloc. In terms of economic growth, the bank expects relatively lacklustre economic growth for this year of positive 0.9%. However, what that is expecting is an increase in growth for the second half of this year, given we are currently in a technical economic recession in Europe, which is 2 consecutive quarters of negative economic growth. If we look into next year, expectation is growth of 1.5%, and then into 2025, 1.6%. To give some real-life context in terms of the effect of monetary policy tightening, then we can see that bank lending to businesses has been moderating month on month since November, so it's starting to squeeze in terms of financial conditions there. Thank you for joining us this week on our review of the central bank policy decisions, and we look forward to bringing you up to date on the key developments here on Morning Markets next week.